We're witnessing a quiet but powerful shift in the crypto markets. Institutional investors have started sweeping up the market. So what does it mean when 205 million XRP is removed from circulation in just 7 trading days? Has the supply crunch that could impact XRP until 2026 already begun? And which institutional giants are behind this silent accumulation? Today, we're discussing a development most of you haven't noticed yet, but one that could fundamentally reshape the market. I'll break down ETF accumulation speed, institutional behind-the-scenes strategies, and the potential liquidity shock that could unfold over the next 6 months. Let's begin. To avoid missing deep dive analyses like this, don't forget to like the video and subscribe to the channel. Now, let's get into the core topic. The data shared by Ripple Bullwinkle is truly striking. Just 7 days after the ETF launches, the landscape already shows how fast the market can shift. 2 institutional issuers, just 2, managed to pull a total of 205 million XRP out of circulation. This number has nothing to do with retail investors. It is purely institutional flow. Canary's XRPC product alone holds a 146 million XRP position, while Bitwise accumulated 59 million tokens in just 2 days. Do these numbers seem ordinary to you? When you look at the daily average, roughly 30 million XRP disappears from the market each trading day. And right now, there are only 2 players. So what happens next week when 5 new ETFs come online? That's where the real question begins. Now let's do the math, because the numbers point to an alarming reality. If this pace continues, the liquid XRP supply on exchanges will face significant contraction heading into 2026. ETFs do not operate like speculative funds. They don't enter and exit positions, they accumulate and hold. Which means once they acquire XRP, it doesn't return to the market. Every day, accessible supply decreases, and this reduction is permanent. Analysts refer to this as the early phase of a supply reduction event. Think of it like Bitcoin's halving, but instead of reduced issuance, this time the tokens are physically removed from circulation. As more issuers enter the scene in the coming months, this rate will accelerate. 2 days, 2 issuers, 200 million tokens. Now multiply that by 10 issuers, or 30. So why are these institutions buying so aggressively? Because they may know something you don't. ETF structures operate with daily accumulation requirements. Whether they have customer inflows or not, they must purchase a set amount of assets. This creates constant buy-side pressure. And remember, these numbers only reflect publicly disclosed ETFs. We have no visibility into what's happening in institutional OTC desks or how much XRP private funds are accumulating. Another critical point, these are structured investment vehicles. They don't redistribute the liquidity they pull from the open market. Every token they accumulate is permanently removed from circulation. The scenario we saw with Bitcoin ETFs is happening even faster with XRP because its liquidity pool is thinner. 6 months from now, the market structure could be completely different from today. As you can see, the market is undergoing a quiet but powerful transformation. Institutional absorption is now too significant to ignore. If you enjoyed this video and want to share your thoughts on how this supply squeeze could affect XRP's price, leave your comments below. Don't forget to like and subscribe. See you in the next video.